Yes. So, good afternoon, my dear friends. On behalf of Fin Ideas, myself, CA Govind Jhamar, I welcome all of you, and I am happy to see nice faces over here in the webinar called Fixed Income Planning oblique Retirement Planning. So, my dear friends, we are starting the session at sharp 4:05 as of now. So the objective of today's webinar is to find out that why fixed income is important. What are the qualities of good plan, good investment plan? Importance of safety in our investments. What is the importance of good returns? Because normally whenever we try to safeguard our investments, we normally start getting very low returns from the market. But there is an importance of good returns also in market, because ultimately we want to plan our long-term fixed incomes through this. So long-term investment, how it can be done through index, how we can get any time money. Whenever we need, we should have money with us. And finally, the index long-term strategy that we are going to understand today. We are from Fin Ideas. Investment के ideas मतलब Fin Ideas. We are SEBI registered investment advisor. So the disclaimer is that equity investments are subject to market risk. Kindly consult your financial advisor before having any kind of investments. We are already dealing with more than 75 members of exchange. We are 26 company in India to register our own algorithms so that people can get advisory through speed, accuracy, and consistency. And finally, we have trained more than 40,000 people till now for investing, trading, and arbitraging. Yeah. So the mission of Fin Ideas is providing transparent solution to everyone for achieving financial freedom. And the vision of Fin Ideas is Fin Ideas will manage wealth of rupees 6,000 crores and serve HNIs and members of exchange globally by 31st March 2023. My dear friends, we are already located in these three countries, India, Dubai, and USA, as well as in these 11 cities. So if you want to have any kind of local support from these cities, you can get it. And finally, during this lockdown period, we have done almost 128 plus webinars. Around 22,200 plus people have registered. Almost 14,000 people have participated. And during this web lockdown period, we have added around 33.5 crore new AUA during this lockdown. And around 115 crore fund we are managing as of now in the strategy which we are going to discuss. So we are talking about this strategy only as of now. So the question comes, why retirement planning? Why retirement planning is important? So my dear friends, retirement planning is important because the average life expectancy has risen, means it is already going up. Almost 80 years plus is the average life expectancy as of now. But we cannot work forever, but money will require at every stage of the life. We are already having our long wish list to prove or to complete. So that is why we need regular money. The uncertainty of future, because we don't know what is going to happen tomorrow. So that is why we require some risk money, some safe to safeguard our uncertainties. Finally, the less dependency on social security or pension. We don't want to dependent on anybody else, any family member. So we don't want them to contribute in our life. Rather, we want to contribute in their life if required. And we want finally less dependency on our family members. So these are few reasons why we need a good retirement planning. So my dear friends, what do you say that we should have very good retirement planning so that we will not get dependent on anyone? Yes or no? Come on. You want to become financial, you want to get financially freedom. Yes or no? Everyone. You can give me reply on chat so that I can understand your feeling as well as your expectations also. Thank you, Ketan bhai, Krishna ji, Gopinath ji, Ravi Shankar ji, Jagdish ji. Thank you, thanks everyone. Very nice. So great friends. So now the next point comes that why fixed income is important. We can have retirement planning with lot of different kind of investments Then why some fixed income we need? So we need fixed income because the first reason is already there on your screen, that we want safety of funds. We don't want every fund of means everyone to play with our fund, or we don't want our fund to get squared off or get means destroyed during the journey of our retirement. So we want safety. We want predictable returns, that I should know that every month I'm going to get this much amount. And we want diversification. I don't want to put all the eggs in one basket. So that is why we need fixed income plans also. And finally, the planning for future becomes very easy when we have fixed income sources and I am having very low stress. And we want to focus on other important aspects of life. So there is money. We know that the importance of money is there, but that doesn't mean that only the money is important in our life. We have a lot of different kind of aspects in our life, so that we can focus on those aspects if we are free from this tension. So now the quality of good investment plan. So from your side, my dear friends, what should be the quality of a good investment plan from your side? If you want to invest money, what should be the feature of your investment? If you want to have some good investment plan, suppose I have come to you, what kind of feature you require? Come on. So I need your participation over here. अगर आपको कोई एक अच्छा सा इन्वेस्टमेंट प्लान मुझे देना हो तो क्या क्या फीचर्स चाहिए आपको? वेरी नाइस, 15% रिटर्न्स पर ईयर स्टेबल. So that is the requirement. So here Mr. Jagdish ji wants that return stability should be there and return should be also a good figure. So 2-digit, almost 15% return should be there. Okay, what else? Okay, safety. Okay, safety band returns over inflation. Very nice, Ashok ji, very nice. So here they want to fight with inflation also, as well as they want safety. Assured with good returns with safety. Very nice, Shankar Rao ji. Okay, assured with good returns. Okay, I read that. Then protection of principal and returns to beat inflation. Superb, Ravi Shankar ji. Very nice expectation. Around 12% return should be there, Gopinath ji. No lock-in period. Lock-in period nahi hona chahiye. 6% returns plus appreciation should be the logical demand. Very nice, very nice. So you guys are really participating in a very effective way. High liquidity, that is very important. We also accept this. So honestly, I accept all the points. That whatever you have shared over here is the real genuine demand from a person who want to get retired or who want to invest money in market. So we need safety, we need liquidity, that whenever we want, we should get our money. We need control on us, means control over, it should be at our end only, that whether I want to move ahead or whether I want to reduce my stake or whether I want to increase the stake. So all the control should be there with me. We need tax benefits also. It should not be very heavily taxable. We want the strategy that should be easy to understand. The proper reporting should be there. I should know each and everything about my plans, my investment. Long lasting, it should have long lasting effects. Scalability, I should be able to invest good money on a longer run. So I hope that we have covered a lot of points over here. Still, there might be few more points. So let us now try to understand that how index long-term strategy can generate systematic regular investment plans, also means systematic regular earnings, as well as it can give us long-lasting returns. So let us try to understand. So whenever we are talking about investment, to understand the investment profile easily, I am taking the example of property over here. Normally, many times we invest money in property at a younger age. Why? Because property gives us two confidence. Confidence number one, that it will never become zero. And the second confidence we are getting from property, that sooner or later it rises. So both the confidence we are getting from properties, but these kind of confidence we are not getting from equity. If we select some wrong equity, then we feel the risk that our money can become zero also. So we are having high risk as well as high returns in equity. But our vision in this product should not be to take high risk. Yes or no? Come on, my dear friends. Yes or no? Here we are not going to take that kind of high risk. Everyone. So if you agree with the point, kindly write down yes. Very nice, very nice, very nice, very good. So we don't want to take that kind of risk. Then what should we do? So first we need to stop trading in individual equities. So no direct shares. No direct shares. What does it mean? That means no direct Reliance, no Tata Steel, no Suzlon, no direct equities. So where are we going to invest? So we are going to invest with indexes. Now the question comes, what are the indexes? So there are mainly two indexes in India. In NSE, we are having Nifty index. In BSE, we are having Sensex as index. So here what exactly the Nifty is, try to understand that why we are recommending to invest money in index at this level. So the first point, yeah, it should not be the costly event. Ashok ji, that's a perfect point. Yes, and the difference between equities, mutual funds and index, that you will come to know, Jagdish ji, in this slide only. So what exactly the index is? So the index is the average of top 50 stocks of India. Now what exactly the meaning of top 50 stocks? So the top 50 stocks means today we are having Reliance, HDFC Bank, TCS, all these stocks in index. But before some time we were having Satyam, Arcom, Yes Bank, all those stocks were also there in index. But as soon as these stocks reach to 51 number, try to understand, this is a very important point. It can make a lot of sense for us. So whenever the valuation of those stocks has fallen down and it reached to 51 number, automatically it moved out from index and new stocks came in. What does it mean, my dear friends? It indirectly means that if the index is the average of top 50 stocks of India, indirectly it gives us the confidence that it can never become zero. Yes or no? Do you agree with this? Come on. Do you agree with this? Because index is the average of top 50 stocks of India, so it can never become zero. And try to understand that we require double-digit growth. As of now, it has become very difficult to earn at least 6% a year from FDs. So we need to understand some other avenues where we can generate good digit returns also, as well as our money should be safe. So as of now, we have got the surety that if I invest money in index, my money can never become zero. It may fall down, it may go up, but it can't become zero. Now the second point. The second point is the valuation of Reliance before some time was around 9 lakh crore. The valuation of HDFC Bank was around 8 lakh crore. So if we total the 50 stocks valuation, it was around 90 lakh crore. That means if I total the valuation of top 50 stocks of India, it was around 90 lakh crore, and this 90 lakh crore was equal to 12,000 index. What does it mean, my dear friends? Very important to understand. When the price of Reliance increases, the value of company will increase. The value of company increases, then this total will increase, and simultaneously this index will increase. And the same rule is applicable when index is falling down, like today. Today market has fallen down. So why? Because the price of these stocks has fallen down. So valuation fallen down, total fell down, and the index fell down. Now the logical question to all of you, that if the richest company of India today is having the valuation of 9 lakh crore, अगर आज इंडिया की जो सबसे करोड़पति कंपनी है वो 9 लाख करोड़ की है, तो जो भविष्य में इंडिया की सबसे रिचेस्ट कंपनी होगी, द कंपनी विच विल बी द रिचेस्ट कंपनी इन इंडिया आफ्टर 5 year, 10 year, 15 year, 20 years, logically that should have the valuation above 9 lakh crore. Yes or no? Logically, there is not the guarantee, but logically it should have the valuation above 9 lakh crore. Yes or no, my dear friends? The richest company, the superpower of India after 20 years. Very nice. So अगर जो कंपनी भविष्य की जो टॉप वाली कंपनी है उसका 9 लाख करोड़ से वैल्यूएशन ऊपर होगा, if that will have the valuation above 9 lakh crore, then the total of these 50 stocks will have the valuation above 90 lakh crore, and simultaneously the index will be about 12,000. What does it mean? It indirectly means that the confidence what we were getting from the property, like it never becomes zero and sooner or later it rises, both the confidence we are getting from the index of that country, because index is the average of top 50 stocks of India, so it can never become zero. And because it is the average of market capitalization. So that is why sooner or later it rises. So how is the history of last 20 years? If we set with example on, okay, so your answer is on your screen now. So just try to see last 20 years over here. And what we can observe, index, it is the average of top 50 stocks. It is rising. Because of sudden things, it has fallen down. Again, it has made new high. Again, it had fallen down. Again, it made new high. It fell down. Again, it made new high, new high, new high, and new high. And this is the 2008, when the economic crash is worldwide. Again, it had fallen down. And again, it had recovered next year. And after 2, 3, 4 years, it has again made new high. Again, it had fallen down, new high. Again, it had fallen down, new high. Can you see this? Can you see this? Try to understand this. Ultimately, we are taking the risk that we are investing money in equities. But ultimately, if you are investing money in index, the basic quality of index is that it is passively managed. What does it mean? Tomorrow, we may not be live. So if our stocks moves to our next generation, then the next generation, then the next generation, whenever our next generation is going to hold those shares, they are going to have top 50 stocks of India if you are having index with you. Are you getting this? So Ravi, yeah, Mr. Ravi Shankar, this is, as of now, I am not having the answer of this question. But your question is very logical. You can Google it out. Yeah, so you can Google it out. And honestly, the fantastic point behind your question, the question from Mr. Ravi Shankar is that which are the companies that were in Nifty 50 at 2002 and now. So you will realize that almost 50 to 60% companies moved out. The stocks, top 50 stocks which were there in 2002 are not there over here, but still the index is making new high. Are you getting this? Are you getting this? So this is the fantastic point of this index mechanism, that index is changing the stocks automatically. Everyone is having the dream that we should buy the futuristic top company of India today. Yes or no? आज से 10 साल बाद जो इंडिया की सबसे रिचेस्ट कंपनी हो वो मैं आज खरीद लूं, हर एक व्यक्ति का सपना यही है. बट nobody knows that which will be that stock, means that stock name we don't know. But if we buy the index, automatically we are going to get that stock in our portfolio, because this is the average of top 50 stocks of India. Great. So now let us move toward the next point, and I am having one fantastic question for all of you. Have you done any kind of investment till date in equity or mutual fund? Have you done any kind of investments? Come on. If you have done any kind of investment, small or big, in equities or mutual fund, then click on yes, else click on no. Last 3 seconds, 3, 2. So I want your participation. The more you participate, the more you are going to learn. And the more you will learn, the more you are going to earn. So my question to all of you, if you have done any kind of investment in equity or mutual fund, click on yes, else click on no. And this is the last second, and I'm closing the poll, and I'm very happy to share this, that almost 89% people have done some or other kind of investment in equities and mutual funds, while 11% people have not done any kind of investment. So my dear friends, it will become very easy for you to understand the concept. Yes. So now the next point, Ankit, I will come to this. Yeah. So the next point is that how we can add safety, because ultimately we learned that we can invest money in equities. But how we can add safety over here? So to add the safety, what can we do? So first, buy the index. Like suppose the index is running at 10,000. So we will buy the index at 10,000, and simultaneously we will buy the put option. Put option means downside safety. So we will buy the safety. If we compare the premium of last 5-6 years, the average premium is around 5% a year. So that means if we pay 5% additional, we are going to get one more benefit, that whenever market will fall down, we will not fall down, rather we will get the difference. So that means that I need to invest 500 rupee more. So my costing will be 10,500. But this 10,500 is giving me the confidence that if market falls down, then my 10,000 is going to remain protected. So what did we do? We have added the safety with our equity. So like we buy insurance, we have bought the put option. Whenever if car met with an accident, so we get the claim. So here if market falls down, we get the difference. So the additional 5% cost is giving us the surety that if I invest 1 crore rupee in market, in no case during full 1 year, my fund is going to go below 95 lakhs. My fund will never go below 95 lakhs. So we have got the surety that my fund is protected. My capital is protected. So this is the good point. So now what will be the charges or what will be the cost? So the worst case scenario is that if market remains at the same level for 4 years, suppose in 2020 index is running near 10,000. Thank you Gopinath ji. So in 2020 index is running at 10,000. We have crossed 4 years and we have reached to 2024. So 4 years have gone. So whatever cost we have paid against the insurance premium, against that put option, that we are going to lose. In between, suppose 2021, 22, 23 market has gone up like last year, 10,000 market, 12,000. Again, it has fallen down like this year. Again, it has gone up and again it has fallen down. So now suppose you have invested 1 crore rupees. See, our vision is that we want to make our retirement completely successful. So for that, we don't want to create heavy risk in our portfolio, but still we want some good return. So how we can add safety with a very low cost? So there is the question from the Ashok Shah. So Ashok bhai, kindly try to understand this. So now here for the portfolio of 1 crore, we are going to put the premium of 5 lakh rupee. So 5 lakh rupee we have paid. Next year market has gone up from 10,000 to 12,000. So market has gone up by 20%. My question to all of you, what will be the value of your portfolio? If market has gone up by 20%, you have made the portfolio of 1 crore at the level of 10,000. Market has become 1.12,000. So where will be the value of your portfolio? Come on, everyone. Again, my question is, you have made the portfolio of 1 crore when market was at 10,000. Market has reached to 12,000. So that means market has gone up by 20%. My question is that where your portfolio will reach? Very nice. So your portfolio will reach to 1.2 crore minus 5 lakhs. Very nice. So ultimately your portfolio valuation will reach to 1.2 crore while your profit will be 15 lakhs. Again, next year you are going to buy the premium to protect your portfolio 1.2 crore. This time you are going to protect the portfolio 1.2 crore. So you need to buy the premium at 6 lakh rupee. You need to pay more premium. Next year market has fallen down from 12,000 to 8,000. So market has fallen down. Now my question is, what will be the value of your portfolio? Market has fallen down by 33% from 12,000 to 8,000. So your 1.2 crore portfolio, where it will reach? Come on, everyone. Very nice, Jagdish ji. Very nice, Krishna ji, Ashok ji, Ketan bhai. Very good. So your portfolio will remain constant to 1.2 crore only. Ashok ji, your question was that to bring it at a lower cost. Try to understand. Compare this or treat this like this is the Mediclaim. You have bought it. This year nothing happened with the health. So you lost this premium. But next year somebody has gone to hospital. So whatever premium he has paid in last 2-3 years, he has recovered at the one shot. Yes or no, Ashok ji? You got this? So here what had happened? Market has fallen down. So your portfolio must have reached to 80 lakhs only, Ankit. But the difference, whatever you have lost over here, you are going to recover it from the put option. Yes or no? Because you have bought this put option for this reason only, no? That whenever market falls down, my value should not fall down. Yeah, so safety means the put option, the protection money. Very nice. That's a very good point, Ravi Shankar ji. Very nice. So ultimately, what exactly had happened? Market has fallen down from 12,000 to 8,000. Your portfolio must have reached to 80 lakhs, but the difference of 40 lakhs you have got from here, what you are going to do of that 40 lakhs? You will again reinvest that at 8,000. So without investing new money, Ashok ji, without investing new money, you have got the fund of 40 lakhs from this claim. You have again reinvested it. So your number of units, your number of equity shares has gone up. And your portfolio is still at 1.2 crore. Again, you have paid 6 lakh rupee. Next year, market has gone up from 8,000 to 12,000. So market has gone up by 50%. What will happen to your portfolio? So what will happen if insurance company becomes bankrupt? This question is not valid as of now, because ultimately this is the exchange only which provides all these things. Are you getting this? So we buy the equity shares from the exchange, and the same exchange is giving us the protection also. Yeah. So next year market has gone up. Market has gone up from 8,000 to 12,000. So market has gone up by 50%. Your portfolio 1.2 crore will reach to 1.8 crore. Again, you have paid the premium. Next year, again, market had fallen down, but your portfolio will remain constant. So this safety, is it the cost for us? Come on. Is this safety has become cost? In 4 years, market had remained same from 10 to 10 only. But your portfolio has become from 1 crore to 1.8 crore. Why? Because of the simple reason, because when you buy the protection, you get some extra advantage, two extra advantage. What are there? The first advantage is that whenever market is going up, you are also going up. The second advantage is that whenever market is falling down, you are not falling down. And the third bonus is that whenever market is recovering from 12,000, index has reached to 8,000. Now it is recovering to 12,000, but you are making new money. Why? Because you were protected. You have paid the premium. We are considering that premium 9 plus 6, 15 plus 6, 21 plus 5, 26 lakh rupee. So indirectly you are not going to receive 1.8 crore. Rather, you are going to receive 1.54 crore because you have paid 26 lakh rupee against premium. But still it is making a lot of sense for us. In 4 years, market has remained constant, but still we have grown. So now that was the theoretical example. Let us move toward the real example. In last 17 years, index has gone up by 12 times. So index has gone up by 12 times. You should have earned 12 times money only. But because you were protected downside, so you have made 17 times money after considering the cost of insurance. You have made 17 times money. Why? Because whenever market is falling down, you are not falling down. But whenever market is moving up, you are moving up. The risk is that you have witnessed the risk of more than 50% in index, but you have never witnessed the risk in this strategy beyond 5%. So that means you have reduced the risk as well as you have enhanced the returns. So normally people are saying that higher the risk is higher the return. We don't believe in that. We believe in that smart calculation makes high returns. For your retirement, for your long-term investment, you can play smartly also. It can make wonders. You will be downside protected, or you will have limited risk, as well as you can generate superb returns in longer run. So how safety value increases when Nifty goes from 10 to 12? My dear friend Ankit, when Nifty moved from 10 to 12, so your portfolio valuation has gone up from 1 to 1.2 crore. So if your portfolio valuation has reached 1.2 crore, and now you want to safeguard the portfolio of 1.2 crore, you need to pay high premium, yes or no? So now Mr. Warren Buffett, he has made billions of dollars from the equity market, and he is concluding his investment life in just two simple rules. That there are only two rules for investment. Rule number 1, never lose money. And rule number 2, never forget rule number 1. Try to understand, my dear friends. It is our own responsibility to protect our wealth. So when a person who has made billions in this strategy, and if he is following that we should never lose money, so that indirectly means that we should try to protect our portfolio. So for retirement planning, why safety is required? Safety is required because at the age after 60, 65, our health is uncertain. We can't predict that we are going to remain completely healthy. Our relationship will be uncertain. Sometime it will happen that the near and dear ones are not there with us. Our social life is also uncertain. We don't know where we are going to stay, because many times we have witnessed that because of kids, we have to shift our places also. So finally, we need to make the certainty against our wealth. Are you getting this? So that is why we need safety of funds, because everything other than the funds are going to remain uncertain. If we are having the certainty about our wealth, it can make wonders for us. Yeah, Arvind, so it doesn't mean that, Hana. So I can see that we are having a lot of questions. So, but we also need to complete the session on time. I will have the question answer round at the end, and I am going to give the answer of all the questions. So kindly stay with your question. You can write down over here so that you can, you can remember the same. So I will be happy to give you the answer of all your questions. So no lock-in period, nothing else, Sagar, over here. So now what exactly the importance of safety? The importance of safety, that if we can safeguard our wealth, we will have certain cash flow, we will have very low stress, and finally we are going to have very low efforts to get our money. So now my question to all of you, and the question is on your screen, and the question is that, do you have any kind of basic understanding of call option and put option? If you are having any kind of basic understandings of call option and put option, click on yes, or else click on no. If you know anything about call option and put option, click on yes, else click on no. Very nice. So last 3 seconds, 3, 2, 1 and 0. And my dear friends, I am really very happy to see your participation. Very nice. So my dear friends, oh, that's great, Sagar. Very nice. I got your point. So almost 57% people understands basics of call option and put option, while 43% people doesn't know anything about call option and put option. Friends, regularly we are keeping the session on learnings also. So we explain there what exactly the futures and options are. So we will recommend you to stay in touch with Fin Ideas. In January month, we are going to come up with the next session on learning of fundamentals of futures and options. It will give you a lot of clarity about this. Now, how exactly a retired person or the person who is planning for the long-term investment, what he can do. So suppose you are having 1 crore rupee with us. Doesn't mean that you have to make the portfolio 1 crore only. You can make the same example with lower investment profile also. Here to make it rounding, I have taken the example of 1 crore rupee. So suppose you are having the 1 crore rupee balance in your bank account. You want to make the portfolio of 1 crore. So now what you need to do? You need to make investment in this way. Invest 30 lakhs in equity ETFs and invest 70 lakhs in debt. What exactly you are going to do? So 30 lakhs rupee you are going to put in index ETF. Someone have asked me that how to buy index. So you can buy index ETFs, exchange traded funds. Those are also listed on equity market. So if you buy the index ETF, automatically you have bought all the shares basket over there. So you don't have to buy all the 50 stocks in your portfolio. Just buy the index. Automatically you have got the like buffet thali. So you have got the thali in your account. So all the 50 stocks you have got over there. So now 30 lakhs rupee you have bought the index. You will put those index as collateral. Collateral means on margin. On those margin, you will buy the index futures. Just don't scare with the name future. We are going to put this money over debt so that we can generate good returns, as well as we will have the safety also. So we have bought the futures of 70 lakhs. So indirectly we have made the portfolio of 1 crore. Our target was to invest 1 crore rupee only. We were having 1 crore rupee in our bank. We have invested those 1 crore rupee by 30 lakhs investing in equity ETFs and 70 lakhs in debt. So 30 lakhs. Yes. So am I audible as of now again? I'm sorry, I got, yes. Okay. Thank you. So we have made the portfolio of 1 crore rupee, and this 1 crore rupee portfolio is giving us the surety that if market moves up, we are going to earn on 1 crore. And if market falls down, we are going to lose on 1 crore. But we don't want to lose on 1 crore, so we will buy the protection. Try to understand. Without protection, don't move in stock market. So we will buy the protection, we will pay the 5% cost. But we know that this 5% is not the cost for us. In longer run, it will become the revenue making tool. But simultaneously, it is giving us the surety that my 1 crore portfolio is going to remain constant. The next cost I need to pay over here because I have invested 30 lakhs only. So 70 lakhs I have bought the futures. That means I have taken the loan. But here we are getting this fund at 5% only in index. So indirectly, we are getting the funds at 5% a year. While we can reinvest those money at 7% easily in index, in long term means in RBI bonds or somewhere else. So the 5% cost is there. So indirectly, we need to pay just 3.5 lakh rupee to take the benefit of this 70 lakhs. So by incurring the cost of 8.5 lakhs, try to understand, 8.5 lakhs is the cost. But this 8.5 lakh is giving us a lot of different benefits. The first benefit is that now we are completely downside protected. The second benefit is that we have used 30 lakhs only for this. 70 lakhs is idle. We are going to generate returns out of this. So now the 70 lakhs, if we put on RBI bonds only, that provides us 7.15% as of now. So if we generate 7.15% on this 70 lakhs, indirectly we are going to generate 5 lakh rupee a year. Yes or no, my dear friends? Come on. Everyone. If we can earn, yes, thank you. So 5 lakh rupee we have again recovered. Now my question is, what is the net cost to me? Try to understand. What is the net cost to us? Our overall cost earlier was 8.5 lakhs. The rest 75 lakhs, 70 lakhs is again generating 5 lakh rupee for us. So what is the net cost to us? Come on, I need the answer from all of you. Everyone. What is our net cost? So our net cost is just rupees 3.5 lakhs. Just by 3.5 lakh rupee cost, we have got the surety that now my fund is going to remain protected while I am going to generate equity returns from the market. And still I have invested money in index. So if I don't do anything, still my money is automatically going to remain protected and passively managed. So my dear friends, this is the very smart way to implement. This is a very smart way to invest. Ultimately, if you are happy with 5% or 6% FD return, then it's okay. But if you want double-digit return, then obviously you need to move towards some other ventures other than FDs. But if you move towards equity or mutual fund, then you are having the question that I want to safeguard my money. At that time, you need to buy the protection. This protection will give you the extra advantage also. For longer run, you have already witnessed that you have outperformed the index. So now what exactly is going to happen? So if we check the past performance with this strategy, we will see that we have never seen the risk beyond 4% a year. So in no case your 1 crore is going to fall below 96 lakh rupee, and still you have generated 18.90% CAGR. Our expectation is around 12 to 15% only. This is the live example of our real customer. We are doing this strategy since 2014. In 2014, suppose someone have invested money and the index. So index has behaved like this blue line, while the customer has behaved in this red line. And this is showing that it has already outperformed. Whenever the market is moving up, he is also moving up. But whenever market is falling down, his loss is 3 to 4% only. Again, market is moving up, he is also moving up. Again, market is falling down, his loss is restricted. Market has fallen down sharply in this lockdown period, in this corona period. But he has never witnessed that kind of risk. While again market is recovered and he still have again started making money. My point over here is to make you understand that you can protect your funds smartly by taking some extra advantages of protection. These are the same graph in data terms. Market has become from 100 to 113. Customer has become from 100 to 120, because whenever market is falling down, he is not falling down. But whenever market is moving up, he is also moving up. Market has fallen down from 113 to 90, but our fund has fallen down to 112 only. Market has gone up and up from 158 to market has fallen down to 97, while customer has fallen down from 187 to 171 only. Next year or same year, market has gone up from 97 to 158. So market has recovered, while here 187 has fallen down to 171, and again it made new high. This is the beauty. So now what kind of systematic withdrawal plan can be added with this feature? So normally we have witnessed that around 18.90% CAGR it had made in last 17 years. But suppose it is making low returns, still you can withdraw easily 6% a year. What does it mean? Normally we are getting 6% return from FDs. That kind of return, if you withdraw, then what is going to happen? Suppose you have made the portfolio 1 crore. Every month you withdraw 50,000 rupees. So this 50,000 will become regular income for you. Still your portfolio will remain constant to 1 crore only. And people who have withdrawn in this way in last 17 years, what exactly was their performance? So suppose he has made the investment of 1 crore. Every month he is withdrawing 50,000. So every year he has withdrawn 6 lakhs rupee, yes or no? If we withdraw 50,000 a month, so every year we have withdrawn 6 lakh rupee, yes or no? And in 17 years, we have withdrawn 6 lakh rupee. So 17 years multiplied by 6 lakh rupee. So we have withdrawn all the 1.02 crore rupee. 1 crore we have invested. Till now we have withdrawn 1.02 crore. So our net investment is zero. Rather it is negative 2 lakh rupee. While still we are having the portfolio of 15 crore with us. So whatever money we have invested, we have got it. And still we are having the portfolio valuation of rupees 15 crore. Why? Because whenever market is rising, you are also rising. But whenever market is falling, market has gone up by 71%, you have also gone up by 67%. But market has fallen down by 52%, you have never witnessed the risk beyond 4%. Are you getting this, my dear friends? Are you getting this? So then the next year market has again recovered, but you have made new profits. So that is why, yeah. So Ravi Shankar ji, what exactly is happening? See, you have invested money in index, you have bought the protection. You have taken the extra advantage of interest rate, because futures you are getting at 5%, while you can put your own money in debt at 7%. So indirectly you are generating 2% more return, so that you can hedge or you can reduce your cost of hedging. So what exactly it had made the combination? You have made the combination by these 3 points. Again, I am just showing you the, yeah, just hold on. So here we have made this portfolio. What did we do? For 1 crore rupee, you have invested 30 lakhs in equities. You have put 70 lakhs in debt. Now first, why we put money in debt? Because debt is generating the returns of 7% while we are being charged for financing cost at 5%. So indirectly we are generating 2% more return. Ravi ji, did you get this point? Come on. Did you get this point? So this is why we have taken the futures over here. Come on, thank you. Now our 1 crore rupee was the target to make the portfolio. So ultimately we have made the portfolio 1 crore rupee. But we don't want to take unlimited loss. So we have taken the complete protection. We have invested this 5 lakh rupee to protect the cost, to protect our portfolio. So this was the cost. This was the financing cost. Overall 8.5 lakh rupee was the cost, but the 70 lakhs has already generated 5 lakh rupee for us. So if you are going to invest 1 crore rupee, you are going to earn 5 lakh rupee from debt. The complete portfolio of this 1 crore is going to charge you 8.5 lakh rupee cost. So ultimately your cost will be 3.5 lakh rupee. Yes or no? Yes or no? Did you get this point? So whenever market is going to fall down, your maximum risk will be 3.5 lakh rupee only. So now just see this table. So by looking at this table is showing us that whenever market has fallen down by 52%, your risk was 4% only. Whenever market has fallen down by 25%, your risk was 4% only. Are you getting this? Because you were protected. But next year, whenever market has gone up, you have again reached to the next high. Are you getting this? Here market has again gone up by 76%. You have generated 73%. So in longer run, you are definitely going to outperform the index. Yes or no? In longer run, we are going to outperform the index. And that is what the science is, or that is what the beauty of this product. Very nice. So what was the smart withdrawal plan? The smart withdrawal plan was that if we invest 1 crore rupee, annually we can withdraw 6 lakh rupee. In last 17 years in the past, given example, we have withdrawn 1.02 crore, but still we are having the portfolio of 15 crore. So the reason for us that we want to protect our money, just remember what were our desire when we asked you that what kind of features we should have in our investment. So the replies what I have got from all of you was that we should have the safety. We are having the safety over here. We should have the good returns of 2 digits. We are having that kind of returns. We should have the liquidity. We are having the liquidity. Whenever you want to get exit, you can get exit from the fund. We should the long lasting effects. We are having that. We should have the control. We are having the complete control with us. Complete control is with the customer only. All the trades are going to happen in customer's own account. So he don't have to rely on anybody else. Even not on us also. Now, if we compare with FDs, in FDs, if we are investing 1 crore, here we are investing 1 crore. In FDs, we are generating 6 lakh a year. Here also we are getting 6 lakhs a year. But on maturity, FD is going to give you 1 crore only back because all the interest you have withdrawn. But here we have withdrawn 15 crore rupee after 17 years. So this is the difference. So what should be the ideal horizon for this? Around 5 years to 10 years should be the ideal horizon. Or logically, your horizon should be that I want to give the fantastic money to my next generation. That should be your horizon. I want my money whenever I want. So you can withdraw money whatever you want. But still your vision should be that ultimately I am not going to use the complete wealth. So whatever money I am having the left, I am going to give that money to my next generation. Yes. Shankarji, you want to see this screen? Yes. Now, what should be the minimum investment? We have given the example of 1 crore rupee. So the minimum investment is around 10 lakh rupee. Why 10 lakh rupee? Because we are getting the minimum lot size in index of 75 units. Index is running near to 13,000 as of now. So around 9,75,000 or 10 lakh rupee is the minimum investment what is required over here. Or in terms of, or in units of 10 lakhs rupee you can invest. Like 10 lakh, 20, 30, 40 or 1 crore and so on. Okay, so you did not understand the withdrawal plan. Arvind, we have invested money in equities as well as in debt. We are generating equity returns and downside is safe. In longer run, if we can generate more than 6% a year, so indirectly, if you are withdrawing 6% every year, your portfolio is going to remain protected. Yes or no? Yeah. So here, Jagdishji, this plan is not having any kind of SIP. Rather, it is having SWP. So customer is not required to invest every month. Rather, he can withdraw every month. You got that, Jagdishji? Now, what will be the fee of FinIdeas? So every 6 months, FinIdeas will charge the fee of 0.75 paisa. That is on 100 rupee, we will charge 75 paisa, 75 paisa every 6 months. If your portfolio is 1 crore, then 0.62. And if your portfolio is 5 crore, then just 0.50. So if you compare this with other investment charges or other revenues, you will realize it that we are among one of the lowest fee charging firm. In mutual funds, if we do it from advisors, we are paying around 1.75 to 2% a year. In PMS, around 2.50 to 3% with revenue sharing also. While here in index long-term strategy, on an average, 1.25% is the fee for a year. So you are having very low charges, as well as you can safeguard your money with complete liquidity, and all the things are going to happen in your own account. So now if we are investing money in equities, try to understand in mutual funds or PMS, suppose you are investing 9 or 10 lakh over here, you can invest the same money in index long-term strategy. So same investment. Now if market becomes double, so your 9 lakh will become 18 lakhs in equities or mutual funds. Here also your money will become almost double. But when market falls down by 50%, your 9 lakh will become 4.5 lakh in direct equities, mutual funds or PMS. While here your 9 lakh will never go below 8.7 lakhs. So you are having low risk downside. Still you are generating good returns upside. You got that? Yeah, Gopal Bhaiya, which slide you want? This slide? You want this slide, Gopalji? Okay, so now the features. My dear friends, it is 4:57. I will complete the session by max 4:05, and then we will have question answer round. Yeah, okay, Gopalji, thank you. So now the features are that this is the combination of equities and futures. This is downside having the limited risk. Completely we are investing money in index long-term strategy, so we are having very low risk profile. Past track record is super solid. We are going to have the complete live access. So that means people are going to have complete live reportings with them. So the one feature what we discussed earlier was that we should have all the reporting. So you are going to have all the reports with you every time. You can have systematic withdrawal plans. There is no lock-in period. Whenever you want to enter, you can enter. Whenever you want to exit, you can exit. But still the logical period is 5 to 10 years. We are having the complete dedicated team for the same. So systematic advisory through algorithm. We have the algorithm so that you can get speed, accuracy, and consistency. People can plan their retirement, their higher education, kids, wedding, all these plans over here. And finally, the golden point, my dear friends. The golden point is that all the trades are going to happen in customer's own account. You should add your nominee over there so that if something happens with your life, automatically your money will should transfer to your nominees so that you don't have any kind of problems. So all these things can be done over here easily. So why good returns are required in retirement planning? Normally, whenever we talk about retirement planning, so we normally discuss only debt plans that we generate 6%, 5%, but it doesn't make sense for a retired person. So retirement planning with good returns is very much required. Why? Because we want to beat the inflation. We want to have financial freedom. We don't want to become burden to our family. And again, we want to live with the good standard of living. So for this, we need good returns, but simultaneously we need safety also. We may have a lot of medical emergencies, so we don't want to become again burden on them. So at the time, we should have good money with us. So now many times we are having the question that index is generating almost 14% return. Ashok ji, if you are there, kindly listen to this point. Many times people are having the question that index are generating 14% or 15% return. This strategy is costing us around 9%. So how it will make money in longer run? Try to understand you have made these three expenses. 5% against hedging, the protection cost. 3.5% against financing cost. And 1.5% or 1.25% against fee. Now all these costs are not the cost for us. Ultimately, all these costs are going to get recovered from their own sources. Why? Because hedging, whenever we are protecting our portfolio, that is not the chanda of mandir. कि मंदिर के चंदे वाले बॉक्स में पैसा नहीं डाला है हमने. We have made one deal over there whenever we are taking this protection, that if market moves up, we will lose that 5% premium. But if market falls down, we are going to get the complete difference. Again, try to understand this. When I buy the put option, I get 2 points. If market moves up, I am going to lose premium only. But I am going to earn on my portfolio, so I am happy with that. And if market falls down, I am going to get the complete difference. So in longer run, I am going to recover this premium. Yes or no? Come on, my dear friends. 1 year I will pay money. So second year I am going to receive also. Because if market moves one-sided, then I am going to lose. But whenever market is fall down, I will recover that. So this hedging cost is not the cost for me. Rather, we have bifurcated the long-term loss in the short-term cost. We have just bifurcated. भविष्य में आने वाले एक बड़े खर्च को हमने पार्ट में बांट दिया. इतना ही किया हमने. पर इसके कारण we have got one extra advantage that whenever market will fall down, we will not fall down. But whenever market will recover, we are going to outperform. So this was the first 5% cost bifurcation. That is not the cost. The second cost is future financing. This is not at all the cost for us. Why? Because 5% we are paying against the financing cost and 7% we are receiving. So this is the direct benefit deal. It is giving us the extraordinary advantage directly. So again, the second point is not the cost for us. Yes or no? Come on. You got this point? Why we are taking the futures? Why we are buying the futures? Because we are getting the futures at 5% cost. While we can put our money in debt and we can generate 7% from debt. So that is why we are outperforming by 2%. And the last one is the FinIdeas fees. 1.25 or 1.5% a year we are charging. Against that, we are handling your portfolio. We provide you that where you should be money, where you should invest money. Wherever you are investing your money, like in mutual fund or PMS, you are already paying the fee, the same fee or the lower fee you are paying to us. We are trying to cut your cost, to save your tax, to efficiently utilize your fund. We provide you continuous reporting. We provide you continuous tracking. So all these things we do for you. And if you see the long-term performance, you will realize it that we are recovering our cost. We automatically outperform your portfolio in such a way. So my dear friends, I hope that you must have liked this idea. If you like this idea, now what should you do? Complete your KYC formality. That means just register yourself. So if you can do your KYC, then we will become open for you to explain you that how you should move ahead. What kind of investment you should do. What kind of money or what kind of plan you should choose. So we can provide you that kind of consultancy. So now you are going to get the link. Pooja will send you the link on your chat. Just click on the link and kindly register yourself. After getting it registered, you will get the extra advantage or you will get the access to your investment planning portal. There you can do a lot of experiments. That what kind of plan you can make and what will be your returns. You may have the question that why FinIdeas? You should choose FinIdeas because we are SEBI registered investment advisor. We are having complete online back offices. We have more than 18 years or 20 years experience of this market, and we are having complete technology to serve you better. You may have the question that does advisor required? Yes, advisor is required because you will require new ideas. You will require complete updation about the exchange rules. strong research is required, technology is required, reporting is required. What should be the best suitable trade for you, how you can cut your cost, how you can take benefit of tax, what the experience is also having the different value. You will require the extraordinary advantage when the disaster happens. And finally, we have a lot of data with us to test all these things. So what is algorithms? So in medical language, like you are doctors, so how you are doing the robotic operations. So the same thing logically is over here. We are having a lot of algorithms. So the computer itself recommends us that this should be the best rate. Here we are having the very low cost of hedging, cost of protection, and this is the very low cost of future. So those all things we are getting from the algorithms. You got that? So here Aman have already shared the link with you. Kindly click on this and register yourself. There are few words what our clients are saying. So we are already touched 505, just 2 more minutes, and then we will have the question answer round. So customers are saying that we have very innovative and smart work ideas. Whenever market falls down, our customers remain safe. We are having the algorithm for advising the trade. People are fully satisfied with the planning and execution through us. People are getting growth of equity market with the safety. People get technology with smartness, and those smartness are unbeatable. We answer all the queries of our customer. These are the feedbacks from our customers. We do not need to worry when market falls down, and they get protected against the worst case situations. People are making money in the most disciplined way. This is the great strategy. So these were the replies from our customers. So friends, कैसा लगा आपको? If you like this idea, just write down yes, so that I can understand that how you have found this webinar. So if you like this idea, kindly write down yes. Everyone. So if you like this, that the concept is good, or it can make sense for you, it can give you some financial freedom, or it can provide you the liberty. Thank you. Thanks a lot, Gopinath ji, Aman, Bhupendra ji, Ashok ji, Ravi ji. Thanks a lot. Thank you, everyone. Thanks for your appreciation. So we are happy to serve you whenever you need any kind of requirement from our side. We will always be there. Thank you, Rajkumar ji, Gopal ji. Thanks for your continuous efforts and support. Friends, every Thursday and Sunday, we are having the program called Smart Wealth Creation Ideas. There we discuss index long-term strategy. So Thursday 4 p.m. and Sunday 10 a.m. Yeah, Ashok ji, you are completely free to ask the questions. Yeah, we are thankful to all our well-wishers. Whenever required, you have given us full support, and you are motivating us to spread our words worldwide. So thank you. Thanks a lot, everyone. Now, friends, if you have liked this idea, you have also got the review link. Kindly give us a small review also, so that we will be happy. Yes. So Ashok ji, kindly ask the question. Would you like to speak or what? Or you want to write? Okay, you want to speak. Okay. So I have given you the right to unmute yourself. You can speak. Anybody else, if you want to speak, kindly raise your hand. As of now, I am lowering all the hands. If you want to speak, you can raise your hands. Yeah, Ashok ji, kindly say.
This systemic withdrawal plan, can we start with a 30 lakhs investment with a 1 CR portfolio, you mean?
No. No. Systematic withdrawal plan, if you want, no, then you need to invest the 100% money. You got that? So for 30 lakhs, you need to make the portfolio of 30 lakhs only, or else you cannot have systematic withdrawal plan over there.
But just now you shown the relax plan, which with the investment of 30 lakhs and 70 lakhs of this thing.
70 lakhs in debt, no? Anna, we have shown you the relax plan. In relax plan, what was the theme? That for the portfolio of 1 crore, you are going to invest 1 crore only. You got that? 30 lakhs you are going to invest in equities, and 70 lakhs you are going to invest in debt. So by this way, you have invested full 1 crore rupee, no, Ashok Bhaiya? You
but
got that?
30 lakhs you purchased from, got at the rate of 5%.
Yes. So
So
30, 70 lakhs we have got at the 5%. Why we have got that 5%? Because the rest 70 lakhs we are investing at 7%. So indirectly we are generating 2% more returns. So that is why it becomes easy for you to systematically withdraw the money every year. Otherwise, if you are investing 30 lakhs only to make the portfolio 1 crore, so that will become basic plan. So at that time, we are not going to earn this 5 lakh rupee from the debt because you have not invested the 70 lakhs rupee in debt. You got that? So if we are not earning that money, then it will become very difficult from this investment to withdraw the money for you every year, because there will be few years when market is not going to perform. So we are going to incur the cost of 8.5 lakhs at that time. And you also want to withdraw the money of that 6%. So that will not become possible. So if you want to withdraw the money systematically every year, then you need to invest full 100%. You got that?
but here you have shown on the relaxed plan with 30% investment and 70% loan and 70.
30%. See, in relax plan, for 1 crore portfolio, how much you are investing? So for 1 crore portfolio, you are investing 1 crore only. 30 lakhs you are investing in equity segment and 70 lakhs you are investing in debt segment. Ultimately, overall, you are investing 1 crore rupee. You got that?
Yeah, I got that, but that another 70 lakhs you have taken as a loan or whatever you call that, this
The
thing,
futures.
future, and that you are at net rate of around 3.5 by investing this in
So
the,
how you reach to the net rate of 3.5?
by
When
investing in
you
the,
have invested 70 lakhs in debt and when it has generated 5 lakh rupee a year, then only your net cost has reached to 3.5 lakh rupee, no? Yes
oh,
or no?
yes, but that means practically I'm investing from pocket 30 lakhs. Is it that?
No, sir. You have invested full 1 crore, no? 30 lakhs you have invested and you have made the portfolio of 1 crore, but that 1 crore is having the cost of 8.5 lakh rupee. So the rest 70 lakhs, what you have not invested, that we are going to park in debt. If we park that amount in debt, we are going to generate the debt return, that is interest income. After considering that interest income, we are having the cost of 3.5 lakhs. Yes or no?
But then why the finance cost of 3.5 lakhs here?
Okay, so the finance cost of 3.5 lakh is here. Why? Because the futures are having the cost of 5% a year only. So it happens or not sometime that of the one bank is giving us the loan at different rate and another bank is giving us the loan at different rate. It happens or not? So here we are getting the futures at 5%, while we can put our money at 7%. So indirectly we are generating 2% extra. That is why we are doing this. You got that?
Okay.
Yes. So your doubt is clear?
So basically we are doing it to reduce that 5% aging cost to 3.5%.
Yes, exactly. Now you got the logic. The
So,
hedging cost of 5%, we want to reduce this cost. So what did we do? We try to take the advantage of interest arbitrage. That we are taking the loan at low rate and we are investing the money at higher rate. So indirectly we are saving money and that money is making sense for us in longer run. You got that?
yeah.
Yes. Okay. Yeah, Sagar, I think he wants to speak. Okay, Sagar. Yeah, I'm Sagarji. You can unmute yourself. We have given you the rights. You have got the message over here. Kindly unmute yourself. And Shiv Kumar, you have raised your hand. Mr. Shiv Kumar, you can also speak. Okay. Is the put option, there is a question from Arvind ji. Is the put option cost fixed at 5% per annum or it keeps on changing? It keeps on changing. But looking at the experience of 5 years, 6 years, last 5 years, 6 years, we can get this cost at 5% easily. Got that? Yeah. So Sagarji, if you want to speak, you must have got the message at your end, asked to unmute. I have given you the rights to unmute yourself. Kindly unmute and speak. Click on unmute and then speak. Yeah. Okay. So if anybody else is having any kind of questions, you can ask me. I will be very happy to give you the answer. And meanwhile, last few more slides that will give you some more. So 1.25% is annual fee. Also, is it on the portfolio or on the invested amount? So here the investment amount and portfolio both are same. Or otherwise, we are going to charge on the portfolio fee. So all the returns you are going to get on portfolio. We are calculating the returns also on portfolio. Risk is also there on portfolio and fee is also there on portfolio. Yeah. Okay, one more question from 70 lakhs debt, 7% is shown as income. Whereas if one comes under 30% IT slab, then returns will be only 5% around. So how do we handle this? So we are handling that point very effectively. Chandra ji, normally see the 70% income is going to come as income from other sources. The cost what we are incurring against this in derivatives market, that is going to come as business expense. So business expense will get settled against the interest income. You got that? So that is why you will not be charged the tax over there on that. Thank you. So how much minimum money required in relax plan? So in the minimum investment, Bhupendra ji, for relax plan is 10 lakhs rupees. Hai? So with the 10 lakh rupee investment, you can do this. Yes. Thanks a lot, Bhupendra ji. Any other question? If you have any kind of question, see, my dear friends, finally, on behalf of Fin Ideas, myself, CA Govind Jhamar, I am thankful to all of you. मैं उम्मीद करता हूं, हम लोग विश करते हैं कि आप लोग अपने जीवन में खूब वेल्थ बनाएं, उसे खूब बढ़ाएं और उसको खूब एंजॉय करें और बाद में अपनी आने वाली जनरेशंस को भी एक बहुत बड़ी गिफ्ट देके जाएं. ये सारे हमारे विशेस हैं आप सब लोगों के लिए. या गोपीनाथ जी, आई एम अनम्यूटिंग यू. यस गोपीनाथ जी. Yeah.
Thank you so much. It has been very useful and very enlightening. Now, just tell me one thing. I'm already invested in index funds. How do I shift? Do I need to, if I have to go for this relax plan, do I now need to exit from the?
Yeah, so that's a very nice question. See, Gopinath ji, if you have already done investment in index, no, you don't have to get exit from that investment.
Okay.
You just need to plan the portfolio in such a way so that we will add the hedges with that protection. And we will also try to see that what kind of investment you have done in that also. And if you have not done that kind of investment, we can plan in such a way so that we can recover our cost. We can try to add the systematic withdrawal plan in this, the same investment, and all the things is going to go with the current investment only. So you don't have to.
So, in other words, whatever I have invested in index plans and debt funds, if I share this with you, you will be
plan it accordingly.
Yes. Plan, and I will continue to be operating the same directly at my level.
Yes. Perfectly correct. You are going to operate the same thing from your level only, number one. Yeah. What is going to happen? The drastic change is going to happen like that.
Exactly.
You are already having the equity returns on your equity investment. You are generating debt return on your debt portfolio. But we will try to make it combine in such a way so that all the portfolio is going to generate equity returns. Okay. And simultaneously, all the portfolio is going to have the debt risk. Try to understand. You got this?
Yeah, and I will be doing everything as a direct investor, right?
Yes, you will be going to do all the things from your end as a direct investor only.
No regular fund, no, it is a direct growth.
Yes, so your money is going to remain with you only.
Okay, like operational and everything.
Yes, everything is with you only. We will advise you on regular basis. We will report you. We are going to have our own back office, so that on the click of buttons, you will get all the knowledge or all the.
And how will you access all my investments subsequently?
Yes, and your investments are going to remain with you only at your.
No, how will you access that?
So we will ask you that you need to make this trade or transaction. And after making that transaction, you will give us the confirmation that yes, I did this transaction at this end, at this date. So we will put that rate in our back office.
Okay.
And by that way, you will get the access that yes, I made these transactions and this is my report.
And whatever is the amount I need to pay to you directly, right?
Yes, whatever is the amount you need to pay us directly as our fee.
Yeah. For 1 CR, what is the amount I need to deposit with you?
So 62,500 plus GST every 6 months.
62,000 means what is the, how did you arrive at that?
So 1.25% a year, payable,
Okay.
payable half monthly. Payable.
Okay.
Yeah.
62,000 and this thing. Okay.
So 62,500.
Thank you.
You got it? Thank you. Yeah. Yeah, Chandra, if we are going to invest, say 1 crore rupee now and have a clear idea on the SWP and plan for the same at the time of investing itself, why is the fee charged every year? Okay, so Chandra, is a very logical question. And what type of support would it be given from FinIdeas? So if we get the clear idea, still you will require every time support from our side. See, market is so dynamic. Every time it shows something new. Every time we get a lot of opportunities from the market. Market moves up, it provides us opportunity. Market falls down, again it provides us opportunity. So all these things you are going to get from us. So you will realize it that it is very advantageous for you to stay with us. And still, if you don't feel that, then you can get exit. You got that? Yeah. So my dear friends, if you have any other question, I will be very happy to give you the answer. You can write on chat also, as well as you can write unmute on chat. I will unmute you. Last 4 seconds. Okay, Gopinaji, for 1 crore, I need to pay 62,500 every 6 months, every half year. Then only 1.25% will reach to annual terms, no? Yeah. And Jagdishji, we do these things on which application? On which application I didn't understand. We are going to recommend you all these things for capital market. Or the members, if you are talking about the members, so you are completely open to trade with any member whenever you want. You got that? Who is your representative in Bangalore? So Chandra, kindly click on the link what we have given below. Okay, so our team will get in touch with you and they will share the number of people who are there in Bangalore with us. Yeah. Yeah, like you can do mutual fund through NJ app, Zerodha, etc. So the same thing. You can do the same thing from these people only. We will provide you the advisory, Jagdishji, and you can trade from any of these members wherever you are having your demat account and trading account. Yes. So I hope that I have given the answer of all the questions. I am really very thankful that you guys are over here till now. Okay, and keep in touch. We will be very happy to share these kind of knowledge every time, and every time we try to bring something new to us, to all of you. So once again, on behalf of FinIdeas, myself, CA Govind Jhawar, I am thankful to all of you. We will meet soon. Thank you. Bye-bye. Thanks a lot. Thank you. Kindly keep in touch. Jagdishji, 62,500 every 6 months. The fee is 1.25% if you are having the fund of 1 crore rupee. So 1.25% of 1 crore. So that will be 1.25 lakhs a year. And you need to pay 62,500 every 6 months. So by this way, you are going to pay the annual fee. You got that? Yes. Yeah. Thank you, Gopinathji. So once again, everyone, thanks a lot. Thanks for coming over here. We will meet soon. Bye-bye. Thank you. So we are completing the meeting over here. Bye-bye.